How do options, futures, and swaps function in capital markets? Imagine a world where investors can manage risk, speculate on future prices, and tailor financial agreements to their specific needs. This world is made possible through the use of financial derivatives such as options, futures, and swaps. These instruments are essential tools in modern capital markets, providing flexibility and efficiency for a wide range of participants. Options are contracts that give the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price within a specified period. There are two main types: call options, which allow purchasing, and put options, which allow selling. Investors use options to hedge against potential price movements or to speculate on the direction of asset prices. For example, a trader anticipating a rise in stock prices might buy a call option to profit from the increase without committing to the full purchase of the stock. Conversely, options sellers collect premiums and assume the risk of having to fulfill the contract if the option is exercised. Futures are standardized contracts obligating the buyer to purchase and the seller to sell an underlying asset at a fixed price on a future date. And like options, futures impose a binding obligation, which means both parties are committed to the transaction regardless of market movements. These contracts are commonly used for commodities like oil, gold, or agricultural products, as well as financial instruments such as stock indices or interest rates. Futures help producers and consumers lock in prices, reducing uncertainty and enabling better planning. Traders also use futures for speculation, aiming to profit from price changes by taking positions aligned with their market outlook. Swaps are agreements between two parties to exchange cash flows based on different financial variables. The most common type is an interest rate swap, where one party agrees to pay a fixed interest rate while receiving a variable interest rate, or vice versa. Swaps are primarily used to manage interest rate risk or currency risk. For example, a company with a variable rate loan might enter into a swap to convert its payments into fixed rate obligations, providing stability in its cash flows. Similarly, currency swaps facilitate the exchange of principal and interest payments in different currencies, helping multinational corporations hedge against exchange rate fluctuations. All three instruments, options, futures, and swaps, serve as vital components in the ecosystem of capital markets. They enable participants to hedge against risks, speculate on future price movements, and customize financial arrangements to meet specific strategic goals. Their proper use enhances market efficiency, liquidity, and stability, making them indispensable in the complex world of finance.